Hope you guys didn't think this was going to be easy. What I'm talking about, silver getting to $100. Well, listen to this. The CME just changed the rules. Silver margins raised to stop $100 silver. The Chicago Mercantile Exchange just dropped a bombshell on the silver market. And if you own silver or you're thinking about buying it, you need to pay attention right now. In late December of 2025, the CME raised margin requirements on silver futures by 30% overnight. Then they did it again just days later. And now, as of January 13th, 2026, they've changed the entire methodology for how precious metal margins work. This isn't just another technical adjustment. This is a fundamental shift in how the silver market operates, and the timing couldn't be more suspicious. Silver was surging. The metal had climbed from roughly $30 an ounce at the beginning of 2025 to briefly touching $80. That's nearly 150% gains in a single year, the best performance since 1979. Then suddenly the CME steps in, margins go up, traders are forced to liquidate, and silver gets smashed back down. Sound familiar? It should, because we've seen this movie before. In 1980 with the Hunt brothers, in 2011 when silver tried to break $50, and now again in 2025. Today, we're going to break down exactly what happened, why it matters, and what this means for the future of silver prices. We'll look at the historical parallels, the China export ban connection, and whether this is legitimate risk management or outright market manipulation. By the end of this video, you'll understand the mechanics of margin requirements. You'll know how they're used to control commodity prices, and you'll be able to make informed decisions about your own silver positions. Let's start with what actually happened, what the CME did and why it matters. The CME Group is the largest derivatives marketplace in the world. They operate the COMEX exchange where most silver futures trading happens. When they change margin requirements, it has immediate and dramatic effects on the market. So what exactly are margin requirements? Think of them as a security deposit. When you buy a futures contract, you don't pay the full value up front. You put down a percentage as collateral. This is called the initial margin. For silver futures in early December of 2025, that initial margin was around $20,000 per contract. Each contract represents 5,000 ounces of silver. So at $30 per ounce, that's $150,000 of silver controlled with just 20,000 down. That's leverage. And leverage works both ways. It magnifies gains when prices go up, but it also magnifies losses when prices fall. Now here's what happened. On December 19th, the CME raised that margin requirement significantly. Then they did it again on December 26th. By the time the dust settled, the initial margin for the March 2026 silver contract had jumped to approximately $25,000. That's a 25% increase in just 1 week. But that's not even the biggest change. On January 13th, 2026, the CME announced a fundamental shift in methodology. Instead of setting margins at fixed dollar amounts, they're now calculating margins as a percentage of contract value. Why does this matter? Because as silver prices rise, the margin requirements automatically rise with them. It's a built-in brake on the market. The higher silver goes, the more capital traders need to maintain their positions. Let's say silver doubles from $30 to $60. Under the old system, your margin might stay at $20,000. Under the new system, it automatically doubles to $40,000 or more. You either post more cash or you're forced to sell. This creates a self-reinforcing downward spiral. Rising prices trigger higher margins. Higher margins force selling. Selling pushes prices down. And the rally dies. The CME says this is about risk management. They claim volatile markets require higher margins to protect against default. But critics see something far more sinister. They see deliberate price suppression to protect short sellers who bet against silver. The historical playbook, Hunt Brothers and 2011. If you want to understand what's happening now, you need to know the history, because this exact scenario has played out twice before, both times with devastating results for silver bulls. Let's go back to 1980. Nelson Bunker Hunt and William Herbert Hunt were two Texas billionaires. They believed inflation would destroy the dollar, so they started accumulating silver. Lots of it. By late 1979, the Hunt brothers and their associates controlled an estimated 200 million ounces of physical silver, plus massive futures positions on top of that. Silver went parabolic. It hit $50 per ounce in January of 1980. Then the exchanges changed the rules. The COMEX and Chicago Board of Trade implemented emergency measures. They restricted new long positions, they raised margin requirements dramatically, and they changed the rules to liquidation-only trading. The Hunt brothers couldn't meet the margin calls. They were forced to liquidate. Silver collapsed from $50 to $10 by March. The Hunts lost billions and eventually filed for bankruptcy. Fast forward to 2011. Silver had recovered from the financial crisis. It climbed steadily through 2010 and into 2011. By late April, silver touched $49 per ounce, just shy of that historic 1980 high, and then the CME acted again. Between April 26th and May 2nd, 2011, they raised silver margins 5 times in 9 days. The initial margin went from $11,475 to $21,600, nearly double. The result was predictable. Silver crashed 30% in just a few weeks. It never recovered that momentum. The bull run was over. Now in 2025, we're seeing the same pattern. Silver surges, margins get raised, multiple times. Price gets smashed. The only difference is the scale. Silver went from 30 to 80 this time. That's even more extreme than previous rallies. Critics call this the silver smash playbook. The pattern is always the same. Let silver rally to build public interest, then pull the rug out with margin hikes when it threatens to break out to new highs. Rinse and repeat. The China factor, export bans and physical shortages. But here's where this cycle is different. This time, there's a fundamental supply shock happening simultaneously, and it involves China. China is the world's largest silver producer. They account for roughly 15% of global mine production. But more importantly, China processes and exports massive amounts of refined silver. Some estimates suggest China controls 70% of the world's silver supply chain. On December 1st, 2025, China announced new export controls on silver. Starting January 1st, 2026, any company wanting to export silver from China needs special government approval. It's essentially an export ban with extra steps. Why would China do this? Several reasons. First, they're stockpiling strategic metals for national security. Silver is crucial for military applications, electronics, and green energy technology. Second, they're responding to Western sanctions and trade restrictions. If the West restricts semiconductor exports to China, China can restrict silver exports to the West. The timing is critical. Just as silver is rallying and the CME is raising margins, China cuts off a massive portion of global supply. This creates a disconnect between paper markets and physical markets. On COMEX, silver can be sold down through futures contracts. Traders don't need physical metal, they just need paper promises. But in Shanghai and other physical markets, silver prices remain elevated because actual metal is scarce. Reports indicate Shanghai silver has been trading at significant premiums to COMEX prices, sometimes $10 to $20 per ounce higher. That's a massive arbitrage gap. It suggests the paper price on COMEX is artificial and suppressed below the real physical price. This is the paper versus physical disconnect that silver investors have warned about for years. The derivatives market has somewhere between 50 to 1 and 100 to 1 leverage. That means there are 50 to 100 ounces of paper claims for every 1 ounce of physical silver. As long as nobody demands physical delivery, the system works. Prices can be managed through paper trading. But when physical shortages emerge, the whole structure becomes unstable. And that's exactly what's happening now. Industrial demand, the solar and data center revolution. Let's talk about why silver demand is surging in the first place. It's not just investors buying coins and bars. Industrial demand is exploding. Silver has unique properties. It's the most conductive metal for electricity. It's the most reflective metal for light, and it's antimicrobial. These properties make it irreplaceable in modern technology. The solar industry alone is consuming record amounts of silver. Every solar panel contains silver paste for conducting electricity. As countries push for renewable energy, solar installations are skyrocketing. The Silver Institute estimates solar demand will consume over 140 million ounces in 2026. That's about 15% of total supply. Then there's the data center boom. Artificial intelligence requires massive computing power. Data centers are being built everywhere to handle AI workloads. These facilities use enormous amounts of silver in electrical contacts, switches, and circuit boards. Electric vehicles are another growth sector. A typical electric vehicle contains up to 2 ounces of silver. As EV adoption increases, so does silver consumption. Medical devices, water purification, 5G infrastructure. The list goes on. Here's the problem. Silver supply is relatively inelastic. You can't just turn on new mines overnight. It takes years to develop new silver deposits, and most silver comes as a byproduct of copper, lead, and zinc mining. When those metals aren't profitable, silver production suffers. Meanwhile, above-ground stockpiles are declining. Governments sold most of their strategic silver reserves decades ago. The COMEX has visible silver inventories, but they're at multi-year lows. Some analysts estimate less than 1 billion ounces of investment-grade silver exist worldwide. So you have surging demand from multiple industries, constrained supply from mines, depleted stockpiles, and now China cutting off exports. That's a recipe for much higher prices, unless someone intervenes to suppress those prices. The manipulation question: risk management or price control? This brings us to the controversial question. Is the CME engaged in legitimate risk management, or is this deliberate price manipulation to benefit short sellers? Let's look at both sides. The CME's position is straightforward. They say margin requirements exist to ensure market integrity. When volatility increases, so does the risk of default. Higher margins protect the clearinghouse and other market participants. They point out that silver did experience extreme volatility. Moving from $30 to $80 in 1 year is unprecedented in modern markets. That kind of price action justifies higher margins from a risk perspective. The new percentage-based methodology makes sense mathematically. If a contract is worth more, the margin should be proportionally higher. It's a more systematic approach than arbitrary dollar amounts. But critics see it differently. They note the convenient timing. Silver rallies toward $100. Then suddenly, margin hikes stop the advance, just like in 1980, just like in 2011. The pattern suggests coordination rather than coincidence. They also question why other commodities don't face similar treatment. Oil has had massive volatility, so have agricultural commodities. Yet silver always seems to get the strictest margin increases at the most critical moments. There's also the issue of commercial shorts. Large banks and financial institutions hold enormous short positions in silver futures. They've bet billions that silver prices will fall. If silver reaches $100 or higher, these institutions face catastrophic losses. The theory is that the CME, which is closely connected to these same financial institutions, raises margins to engineer sell-offs. This protects the shorts from having to cover their positions at much higher prices. It's a form of regulatory capture, where the exchange protects its largest participants. Evidence for manipulation includes leaked documents and regulatory fines. In 2020, JP Morgan paid over $900 million to settle charges of spoofing and manipulation in precious metals markets. Traders were found guilty of placing fake orders to move prices. If manipulation happened for years with fake orders, why wouldn't it happen through margin policy? The tools might be different, but the goal is the same: control prices to benefit insiders. What this means for silver investors. So what should you do if you own silver or you're thinking about buying? Let's break down the implications. First, understand that futures market manipulation doesn't change the fundamentals. China's export ban is real. Industrial demand is real. Supply constraints are real. These factors support higher silver prices long term. What margin hikes do is create short-term volatility. They force leveraged speculators out of the market. This causes temporary price drops. But it also creates buying opportunities for those with longer time horizons. History shows that the strongest advances in precious metals often follow margin-driven corrections. After the Hunt brothers' collapse, silver eventually climbed back. After the 2011 crash, silver had another major run. These pullbacks shake out weak hands before the next leg up. If you own physical silver, margin changes don't affect you directly. You're not trading futures. You don't face margin calls. You can simply hold your metal and wait out the volatility. If you're trading futures or leveraged products, you need to be much more careful. Understand that margin requirements can change at any time. Have adequate capital to weather increased requirements, or consider reducing leverage to avoid forced liquidation. Some investors are shifting from paper silver to physical metal. They see the disconnect between COMEX prices and physical premiums. They want to own real silver rather than paper promises. This makes sense if you're concerned about counterparty risk or market manipulation. Others are looking at silver mining stocks. These companies benefit from higher silver prices without the margin risk of futures trading. Though mining stocks carry their own operational and geopolitical risks, the key is to match your silver strategy to your risk tolerance and time horizon. Short-term traders need to respect the power of margin changes. Long-term investors can look through the noise to underlying fundamentals. The road to $100 silver. Let's talk about where silver goes from here. Can it still reach $100 per ounce? Or have the margin changes killed the rally? The bear case says the momentum is broken. Margin hikes have forced selling. Technical damage is done. Traders are scared to rebuild long positions because they fear more margin increases. Without speculative buying, silver lacks the fuel to push higher. The bull case says this is just a pause. The fundamental drivers remain intact. China's export restrictions will tighten supply further. Industrial demand keeps growing. Investment demand is increasing as more people discover silver's story, and the margin changes might actually confirm how threatened the establishment feels by rising silver. Prominent analysts like Mike Maloney argue that CME margin increases are actually bullish long-term. They see them as desperate attempts to contain a bull market. The more desperate the measures, the stronger the underlying trend must be. There's also the inflation factor. Central banks have printed trillions of dollars. Government debts are at historic highs. Eventually, this creates inflation pressures. Silver has always been an inflation hedge. As inflation fears return, silver benefits. Some analysts predict silver could reach $100 within the next 2 to 3 years. Others think it could happen faster if physical shortages intensify. A few believe silver could go even higher, to $150 or $200, if the derivatives market breaks down. The ratio between silver and gold also suggests upside potential. Historically, the gold to silver ratio averages around 50 to 1. That means 1 ounce of gold equals 50 ounces of silver. Currently, the ratio is still above 70 to 1. If it returns to historical norms while gold stays elevated, silver would need to rally significantly. But timing is impossible to predict. Markets can remain irrational longer than you can stay solvent. The CME can keep changing rules. Governments can intervene in commodity markets. Black swan events can derail any trend. What we can say with certainty is that silver is at a critical juncture. The margin changes represent a major test. Either they succeed in capping prices or they fail, and silver breaks out anyway. We'll know which scenario plays out over the coming months. Final thoughts and action steps. The CME's decision to raise silver margins and change the methodology isn't happening in a vacuum. It's part of a larger struggle between market forces pushing silver higher and institutional interests trying to keep a lid on prices. We've seen this playbook before. In 1980 and 2011, margin hikes successfully ended silver rallies. But we've also never seen a confluence of factors like we have now. China export bans, record industrial demand, declining inventories, growing awareness of market manipulation. The paper silver market is under stress. The derivative structure that has controlled prices for decades is showing cracks. Whether it breaks entirely or manages to hold together remains to be seen. For investors, the lesson is clear. Understand the difference between paper and physical markets. Recognize that short-term volatility doesn't change long-term fundamentals, and be prepared for continued manipulation attempts as silver threatens to break free from decades of price suppression. If you believe in the silver story, use pullbacks as opportunities. Dollar cost average into positions rather than trying to time the perfect entry. Consider physical metal over paper products if you're concerned about counterparty risk. And stay informed about ongoing developments in China, industrial demand, and regulatory changes. The battle for $100 silver isn't over. It's just entering a new phase. The CME has shown its hand. Now we'll see if market forces can overcome institutional resistance. If you found this analysis valuable, make sure to subscribe to the channel. We'll be tracking the silver story closely as it develops. Leave a comment below with your thoughts on the margin increases. Do you think this is manipulation or legitimate risk management? And where do you see silver prices going from here? Remember, this is not financial advice. Do your own research. Consult with qualified advisors before making investment decisions. But stay informed, stay vigilant, and understand the game that's being played in the silver market. Because this story is far from over. The next chapter is being written right now.